If you've been watching silver and you feel like you just witnessed financial history being written in real time, you're not losing your mind. What happened on January 30th wasn't just another red candle on your chart. It was the worst single-day collapse in silver since March 1980, 31.4% gone in one session, from $121 down to $78.53. And here's what nobody's talking about right now. While everyone's panicking about the crash, JPMorgan just made a move that tells you exactly what they think happens next week. And the data that leaked out of COMEX depositories over the last 72 hours suggests someone knows something the retail market hasn't figured out yet. Before we get into what JPMorgan did and why it matters, you need to understand the three forces that collided on January 30, because this wasn't random. This was engineered chaos with a purpose, and the physical market is screaming something completely different than what the paper price is telling you. I'm going to show you the exact number that determines where silver goes in the next 7 days. But first you need to see what just drained out of COMEX vaults, because that story hasn't hit mainstream yet. So let's start with what actually happened. As of February 1st, 2026 at 9:40 a.m. Eastern Time, silver is trading at $85.91 per ounce. That's down 26.14% from where we started the week. Gold is sitting at $49.0385. The gold-to-silver ratio, which was at 47-1 just 2 days ago, spiked to 57-1 in the chaos. That's a 23.69% jump in the ratio in 24 hours. That is the biggest single-day ratio spike in 50 years. Let that sink in. The relationship between gold and silver changed more dramatically in one day than it has since the Hunt brothers era. Now here's where this gets interesting. On January 7th, COMEX delivery data showed that 1624 contracts for January delivery got stood for delivery. That's 8.1 million ounces of physical silver that had to leave the vault. Then in the first week of January alone, 33.45 million ounces withdrew from COMEX warehouses. That's 26% of available registered inventory gone in 7 days. As of mid-January, registered silver, that's the metal actually available for delivery against futures contracts, dropped to just over 30 million ounces. 30 million. Do you understand how insane that number is? There are 500 million ounces of open interest in the March contract. That means the paper claims on silver are more than 16 times higher than the physical metal available to deliver, 16-1. This is not a normal market structure. This is a powder keg that was waiting for a spark. And on January 29th, silver hit $119.47. It felt unstoppable. The gold-silver ratio compressed to 46-1, levels we haven't seen since 2011. Stackers were celebrating. Traders were counting their gains. And then January 30th happened. The dollar index, which had been weakening for months, suddenly surged. DXY jumped from 96.17 to 97.15 in a single session. A 74 basis point spike. That doesn't sound like much until you realize that in the precious metals world, every tick higher in the dollar makes gold and silver more expensive for international buyers. Demand evaporates. The selling pressure builds. But here's what's weird. The dollar didn't strengthen because the economy suddenly got better. It strengthened because President Trump nominated Kevin Warsh as the next Federal Reserve chairman. Stop. Think about that for a second. A personnel announcement at the Fed triggered the biggest metals crash in 46 years. Why? Because the market interpreted Warsh's appointment as a signal that Fed independence would be preserved, that interest rates wouldn't get slashed to juice markets, that the dollar wouldn't be deliberately destroyed to benefit debtors. The minute that headline hit, algorithmic trading systems that had been net long precious metals started unwinding positions. Margin calls went out. Leveraged speculators got liquidated. And because silver is the most volatile of the precious metals, it got hit harder than anything else. Gold dropped 11.4%. Silver dropped 31.4%. The fear wasn't that silver fundamentals had changed. The fear was that the easy money trade was over. Now let me tell you what JPMorgan did, while everyone else was panic selling. According to a COMEX report that surfaced within the last 48 hours, JPMorgan closed its short position in silver, around $78 per ounce. Read that again. They were short, they rode silver down from 121 to 78, and then they covered. They closed. They're out. Now ask yourself, if JPMorgan thought silver was going to $50 like some analysts are screaming right now, why would they close the short at 78? Why not ride it lower? Why not wait for the real capitulation? I'll tell you why. Because they know something about deliverable inventory that retail doesn't. Here's what I found when I pulled the Shanghai premium data. Throughout January, physical silver in Shanghai was trading at a premium to COMEX spot. When paper said 101, you couldn't get metal in China for under 104. That's a $3 premium on a market that's supposed to be globally fungible. When paper crashes to 78, but dealers are still quoting $90 for immediate delivery, You no longer have a unified pricing mechanism. You have a fractured market where paper and physical are decoupling, and that fracture is what tells you the real story. Let's go back to registered inventory for a second, because this is the number that determines what happens next week. 30 million ounces of registered silver sitting in COMEX vaults as of late January. The March futures contract, which is the front month, has open interest representing 500 million ounces. If even 10% of those contracts stand for delivery, that's 50 million ounces of demand against 30 million ounces of supply. The math doesn't work. Now I know what you're thinking. Most futures contracts don't stand for delivery. 99% roll forward or cash settle. That's how the system's supposed to work. But what happens when physical buyers in Asia, stackers who've been waiting for a dip, and institutions that need real metal all decide to take delivery in the same month? This is where it gets uncomfortable for the banks. Because if you're JPMorgan and you're short silver, and you have to deliver physical metal that you don't have, you have two choices. You either buy it in the spot market and watch the price explode as you cover, or you engineer a price crash to shake out the weak hands, reload your physical at lower prices, and cover your short at a profit before delivery pressure comes back. What happened on January 30th fits the second scenario perfectly. Algorithmic selling. Margin hikes from CME Group announced after the close. Mainstream media immediately calling it a speculative bubble bursting. All of it designed to create maximum fear and maximum liquidation in minimum time. But here's what they didn't count on. Retail didn't sell. I've been watching dealer inventories. Retail buying surged on the dip. Guys who were priced out at 120 were backing up the truck at 85. The physical market absorbed the paper crash and said thank you for the discount. And that's the tell. That's the signal that this wasn't the end of the silver move. It was a violent reset inside a larger structural bull market. Now let me show you the contrarian data, because I'm not here to just pump hopium. There are real risks. JPMorgan's former strategist Marko Kolanovic came out 2 days ago and said the rally in silver is headed for a reversal. He's calling for mean reversion back toward $50. His argument is that silver got overbought. Speculative positioning was at extremes, and the fundamentals don't justify triple-digit prices. I actually think he's half right. Silver did get overbought. The move from $30 in early 2025 to $121 in January 2026 was a 147% gain in 13 months. That's parabolic. That's not sustainable. But here's where I disagree with him. He's treating silver like a normal commodity. It's not anymore. Silver entered 2026 with the fifth consecutive year of structural supply deficits. The Silver Institute forecasted a deficit of 117 million ounces for 2025 alone. Mine production has been declining for a decade, especially in South and Central America, due to resource depletion and infrastructure challenges. Meanwhile, industrial demand for solar panels, electric vehicles, and electronics keeps growing. Investment demand from ETFs like SLV and PSLV surged through 2025, and now you add in the COMEX inventory drain, and you have a setup where the price isn't just about speculation. It's about whether there's enough physical metal to meet real-world demand. Here's the philosophical question nobody's asking. What is the fair price for an asset where paper claims outnumber physical supply 16 to 1? If you're holding a futures contract that says you own silver, but the warehouse only has enough metal to satisfy 6% of claims, do you really own silver, or do you own a promise? And when does the market start pricing in the difference between a promise and a bar? That's the transition we're watching right now. It's messy. It's volatile. It's going to trap a lot of traders. But for people who understand the difference between paper price and physical availability, this is the opportunity of the decade. Let me give you a historical parallel. In 1979 and 1980, silver went from $6 to $50 in less than a year. Then it crashed back to $10 within 2 months. The Hunt brothers tried to corner the market, got margin called, and the whole thing collapsed. Everyone said silver was done. It was a speculative mania. It would never come back. But if you zoom out, that spike wasn't random. It happened because inflation was out of control, the dollar was losing trust, and people were fleeing into hard assets. The crash didn't happen because silver was worthless. It happened because the leverage got too extreme and the system forced liquidation. Does that sound familiar? Because that's exactly what just happened on January 30th, 2026. The difference this time is that the structural deficit is real. We're not dealing with just investment speculation. We're dealing with a metal that's being consumed faster than it's being mined, where above-ground inventories are draining, and where central banks and institutions are quietly accumulating while retail fights over the scraps. And JPMorgan closing their short at 78 tells me they see that too. They're not holding for 50, they covered, they're done. And now the question is whether they flip and go long before the March delivery squeeze starts. Here's what I'm watching in the next 7 days. First, COMEX delivery data for February. If we see another surge in contracts standing for delivery, that confirms the physical shortage story. Second, Shanghai premiums. If the gap between paper and physical widens again, that tells you international buyers don't trust COMEX pricing. Third, dealer inventories in the US and Europe. If premiums over spot stay elevated, and wait times for delivery stretch out, that's your signal that physical is tight no matter what paper does. Fourth, the dollar. If DXY rolls over from 97 and starts weakening again, metals catch a bid. If it keeps strengthening, we could see more pressure. But here's the bigger picture. Silver just did in 2 days what it took months to build. It went from 121 to 78 and bounced back to 86. That's a 40% round trip in 48 hours. That level of volatility doesn't happen in a dead market. It happens when there's a massive fight between paper sellers and physical buyers over who controls the price. And every time we see this kind of violence, the floor gets higher. In 2020, silver bottomed at $12 during the COVID crash. In 2023, it bottomed at 20. Now after this crash, we're holding above 80. The trend is clear. So what do you do with this information? If you're trading futures, you just learned that this market can move 30% against you in hours, and your stop loss means nothing. If you're stacking physical, you just got handed a gift. $85 silver when it was 120 a week ago. If you're waiting for 50, I'll be honest, I don't think you're going to see it. JPMorgan didn't wait for 50, they covered at 78. That should tell you something. If you're new to this and you're scared because everyone's calling this a bubble, let me ask you a question. When COMEX registered inventory is at 30 million ounces and open interest is at 500 million, who's in the bubble? The guy holding a physical bar, or the guy holding a paper contract backed by metal that doesn't exist? This isn't about predicting the exact price next week. I could be completely wrong about the timing. Silver could chop sideways for a month. It could retest 70. But the setup is binary. Either the paper system regains control and beats the price back down for another cycle, or the physical shortage forces a repricing and we look back at 121 as the preview, not the peak. And every data point I'm seeing, from inventory drains to dealer premiums to JPMorgan's behavior, suggests the latter. March delivery starts in 10 days. If open interest on the March contract stays elevated, if registered inventory stays below 35 million ounces, if Shanghai premiums stay wide, something is going to break. I'll be tracking this daily. Next video drops in 48 hours with updated delivery data. Comment the word squeeze if you think the physical market wins this fight. Comment bubble if you think we're going back to 50. No explanation, just one word. I want to see where this community stands right now, because your conviction in the next 2 weeks is going to determine whether you hold through the noise or panic sell at the bottom. One more thing before we close. The narrative you're hearing on mainstream financial media right now is that silver was a speculative bubble, and it popped, and it's over. They said the same thing in 1980. They said the same thing in 2011. And every single time, the people who understood the physical shortage, who ignored the paper volatility, who kept stacking, came out ahead. This is not financial advice. I'm just a guy reading data and trying to make sense of chaos. But when I see 33 million ounces leave COMEX vaults in 1 week, when I see the gold-silver ratio spike 24% in 1 day, when I see JPMorgan cover their short at 78, while retail panics, I know we're in the middle of something historic. The only question is whether you're positioned to benefit from it, or whether you're going to let fear make your decisions. This isn't about where silver goes tomorrow. It's about whether the paper price and the physical price are still measuring the same thing. And if they're not, which one do you trust? I trust the metal. I trust the math. I trust the fact that you can't print silver, and you can't deliver contracts that don't have metal behind them forever. At some point, physics wins. And when it does, the guys holding real bars are going to be just fine. The guys holding leveraged paper positions might not be. Choose accordingly. I'll see you in 48 hours with the next update. Until then, stack smart, stay liquid, and don't let a 2-day price move shake you out of a 10-year thesis.